Welcome back to RR Corporates. We have two channels, RR Corporates and RR Legal Talks. Voluntary strike off under Section 248 of the Companies Act 2013, including legal provisions, step-by-step process, practical tips, and post-strike off consequences. So we are going to discuss in detail. It's a simplified exit route under Companies Act 2013. So, namaste friends, welcome back to the channel. If your company is no longer active or has no operations, there is a clean, cost-effective way to exit. It is called voluntary strike-off under Section 248 of Companies Act 2013. In today's video, I will explain who can apply for strike-off and who cannot apply for strike-off. The detailed step-by-step procedure, all forms involved, STK2, STK3, STK4, STK8, MGT14, and time frame, cost, and what happens after strike-off, including liabilities and restoration rules. So let's dive deep into this simplified exit route under Companies Act, Section 248 and Section 249. This is the legal background. Section 248, subsection 2 of Companies Act 2013 allows a company to apply for removal of its name from the register of companies if it has not commenced any business or has ceased business for last 2 years. Section 249 puts restrictions on applying for strike-off. So the companies which cannot apply for strike-off. So that Section 249 clearly states which cannot apply under Section 248. Ineligibility. So within last 3 months, a company cannot apply if it has changed its name, shifted its registered office across the states, disposed of property outside ordinary business, undertaken activities unrelated to winding up, applied for compromise scheme with NCLT not concluded, already wound up under Chapter 20 of RIPC. These checks ensure strike-off is used only by companies genuinely looking to close, not to avoid compliance or liabilities. That is the reason there are restrictions under Section 249 of Companies Act 2013. Section 249 puts these restrictions. Now, we have explained which company can apply, which cannot apply. Then, step by step, strike-off process. Step 1, board resolution. Call board meeting within 7 days notice. With 7 days notice, follow secretarial standards. Ask resolution to initiate strike-off. Authorize director to file an application. Step 2, extinguishment of liabilities. Pay off all outstanding liabilities. Else produce a nil balance sheet certified by chartered accountant. Mandatory to close all bank accounts. Step 3, shareholders approval. Hold EGM or AGM. Pass a special resolution or take consent with 75% of the shareholders. If a company has only two shareholders, both must agree. Step 4, file form MGT14, special resolution in MGT14 within 30 days of passing it. Attach certified minutes and resolution. And step 5, get regulatory NOC if applicable. It is not mandatory. Step 6, file form STK2 with ROC. And what are the attachments? STK3, this is indemnity bond from all directors. Indemnity bond from all directors on 100 rupees stamp paper and notarized. STK4, affidavit from all directors and 100 rupees stamp and notarized. STK8, statement of assets and liabilities certified by chartered accountant, not older than 30 days. Certified copy of special resolution, statement of pending litigations, if any, closure certificate of all the banks, NOC from regulators, if applicable, These are all the attachments to STK2. What about fees? 10,000 rupees, ROC application fees, and public notice, and then objections, if any. ROC issue notice in STK6 via MCA website, official gazette, one English and one vernacular newspaper. 30-day objection window will be there. Any creditor, any shareholder, any stakeholder or authority can file an objection. Strike off order and dissolution. If no valid objections, then ROC issues final strike off order in form STK 7. If no valid objections, then ROC issue final strike off order in form STK 7, publishes in the official gazette. Company stands dissolved from the date of gazette notification. Timelines and costs. Typically, so 3 to 6 months from STK to filing to final order. And fee, yes, 10,000 ROC fee and professional fees. Post strike off compliances, FX. What is the implications? Post strike off implications, not compliance, implications. Company ceases to exit. So company ceases to exist. And PAN and TAN becomes inactive. No business or legal transactions allowed. Then director's liability continues. Personal liable for undisclosed liabilities. Action can be taken even after dissolution. Then restoration possible. Appeal to NCLT under section 252 if strike off by ROC within 3 years. If voluntary strike off within 20 years. Restoration can be requested by the company, creditor, or any affected party. The practical tips. Keep proper documentation, affidavits, indemnities, and balance sheets ready. Make sure all regulatory dues, GST, income tax, PF, ESA, etc., shall be clear. Update DIN KYC and file pending forms if any. Don't file strike off to escape penalties. ROC will reject or penalize. Use professional help to avoid rejection or refiling. So the conclusion is, so friends, that is everything you need to know about voluntary strike off under the Companies Act 2013. It is a very simple, cost effective and clean, but only when done properly. Ensure eligibility, follow step-by-step procedure, step-by-step compliances, protect directors by closing all the liabilities, and always document everything well. If this video helped you, do like, share, and subscribe for more such in-depth compliance content. If you hit the bell icon, you will not miss any of the legal and latest updates. You will not take any of our videos. We have two channels, RR Corporates and RR Legal Talks. Please do subscribe both the channels, RR Corporates and RR Legal Talks. There is a disclaimer. This video is for educational purpose only and not legal advice. So for case-specific consultation, please consult a company secretary or a legal expert. Thank you. Thank you very much. Don't forget to subscribe RR Corporates and RR Legal Talks. Thank you.